After all the anticipation, all the low-key hype, the all-important June CPI comes out, and it was something. June makes 5 months since tariffs were applied to America's 3 largest trading partners. And that's the real story here, the one no one wants to talk about. How after 5 months, there hasn't been a big surge in consumer prices. And we got more evidence today that shows why that's been. Now, there were some signs that businesses are passing some higher input costs to consumers in items like toys, furniture, and appliances, but it was entirely muted, leaving everyone to really ask themselves why they weren't bigger and in far more places. In broader categories like cars and travel, there was nothing. For autos, it was less than nothing. I've said all along there would be short-run impacts from tariffs on consumer prices, but it wouldn't lead or even really be about inflation. It's the lack of impact on consumer prices that everyone really should be talking about, because the tariffs are happening, and the big jump in the CPI is definitely not happening. It's because pricing power among businesses is absolutely not there. 5 months now is more than enough to make a judgment. Yet for those like policymakers at the Federal Reserve, they're going to take these small little nuggets of rising costs and now forecast them into a summer filled with inflation, basically moving the tariff inflation goalpost further down the 2025 calendar. Consumers are more than cautious. They're actually cutting back. And so businesses, they have very few options. They do have a few, but not many. And that's what the CPI really shows. 5 months into tariffs, the tariff inflation remains absent, and that's the entire story. According to the Bureau of Labor Statistics, the headline consumer price increase in the month of June was 0.29%, which was basically in line with the 0.3% month-over-month change that was expected. It did bring the year-over-year rate to 2.67% from 2.38% last month, but that was simply because June CPI, June of 2024 CPI was 0. Now the core rate, which is what most people are watching, that one was less than expected. It came in at 0.23% month over month, which was below the 0.3% that was also expected for the core CPI, just like the headline. And while it did accelerate from May, which was almost flat at 0.08%, the core CPI has been back and forth since January. So nothing much, nothing meaningful has changed even in the core CPI so far. And if you look at the core rate over the last 4 months, it's rising at just below a 2% annual rate. So despite the fact that we have tariffs in these 4 months, in fact, the tariffs have been ramping up in these 4 months, the core CPI has not meaningfully accelerated. In fact, in these 4 months, it is rising at a rate that would be below the Federal Reserve's target, as if we wanted to take that seriously. Moreover, the increase in the CPI, including recently, has been mostly due to the shelter index. As always, we have the shelter and the imputation problem. As the BLS press release for the month of June said, the index for shelter rose 0.2% in June and was the primary factor in the all items monthly increase. And it has a much bigger impact on the core rate, since the core rate is more heavily exposed to this fake shelter computation. But here's another thing in the CPI. The shelter index actually only increased by 0.18% in June, which is actually the slowest monthly gain since February of 2021. And the year-over-year change was just 3.8%, which is also the lowest of the cycle. No thanks to the OER part of the shelter index, or owner's equivalent rent. That one still rose at a 0.3% monthly rate, but that's where all the fakery is. So the difference between OER and the overall shelter index means that the fake stuff is still holding prices and price gains higher. Meanwhile, those categories and those individual items that are more exposed to the real economy, that are actually dealing with the real economy, like hotel and lodging, those are actually, the prices there in the real economy are actually falling, which means that the shelter index overall, held high by OER, but then brought lower by the real economy, gets it down to 0.18%. And even then, it was still the biggest contributor to especially the core rate, but also the all items index as well. So you have the fakeness in the CPI that is still there, even as the real economy parts of the shelter index are trying to reflect more of reality and bring prices down. Now, in one segment where tariffs were really supposed to have a huge and immediate impact, That's the auto business. I mean, consumers rushed out to buy cars and trucks and everything else, especially in March, trying to beat tariffs, trying to beat the huge surge in prices that everyone expected from tariffs. But according to the Bureau of Labor Statistics, new car prices overall have been declining, not just declining over the last several months, they've been declining here in June at an accelerated rate. I mean, cars were basically ground zero for tariffs. And many consumers, like economists, thought their prices would be through the roof. Instead, they declined by 0.34% month over month in June, which is the third negative for this part of the index in a row and the fourth out of the last 5 months. So after all that front running, it has left the payback, the air pocket that we've been talking about, which has left auto dealers holding the bag with a bunch of inventory that maybe they can't sell at the rates and prices that they want. Even used car prices fell here in June, down a 0.7% rate on the month after following a 0.5% decline in each of the 2 months prior, both April and May. So even where you would expect or you'd think that tariffs would have the most immediate and direct impact in the auto business, the BLS says it isn't happening at all. Again, they have to ask the question why, or really in this case, why not? It's weak demand more than tariff pricing. Before we get to the rest of today's video, we do have more of our Eurodollar University anniversary sale coming up. The webinar was only the first part of it. We'll have sales on the subscriptions to the membership and the daily briefing. Plus, we're also launching a brand new subscription over at Substack. Those details will be available at our website, eurodollar.university. We'll have more to say here on YouTube as well, but stay tuned for all of that. So does the June CPI provide enough clarity? And we ask that question, most people mean in relation to the Federal Reserve. If we're asking if the CPI provides some clarity where it really matters in the real economy, the answer is closer to yes, because weak demand is keeping the tariff pass-through from showing up. Now, there's some of it in the CPI report, as we said, but nowhere near as much as most people, especially those proponents of tariff inflation like Jay Powell, they've been saying all along. So they're going to keep moving the goalpost further out in time. It was supposed to be here in the late spring, and then that didn't happen. Now they're saying it's going to be the summertime, then maybe it'll be the fall, and who knows, maybe by the middle of next year, tariffs will lead to this massive inflationary wave that the Federal Reserve needs to hike rates over, that Jamie Dimon, at least we talked about in yesterday's video, has been warning about. But the fact that the CPI has consistently come in weaker than those expectations, that is what is important, not the next set of tariff inflation expectations. And so the only question we should be asking is why not? Where is this tariff inflation? Why isn't it happening? Why aren't they already pushing consumer price rates higher, far more than they have? Like I said in the introduction, there will be impacts, there will be higher costs from tariffs, but we've expected them to be muted like they have been because of the shift, the clear shift, and the clearing up shift in the consumer economy. Consumers have hit the wall. Therefore, businesses that are seeing their prices rise have been unable to pass those costs all the way to consumers in the way that they otherwise would have. But the fact that you can find some categories where there is tariff pass-through going on, that's going to provide more ammunition to keep the tariff inflation narrative alive, because it's been entirely theoretical this entire time anyway. So you give it a little bit of here's a couple of things where tariffs are being passed through. Suddenly that leaves the doors open for a summer filled with even more of it. When the data shows the consumer environment is nowhere near close to that, then it would allow something like that to continue to happen over how many more months are we going to need to see it? So I think Bloomberg in this article sums it up pretty well. It writes, underlying U.S. inflation rose by less than expected for a fifth month in June, even as the details signal companies are beginning to more meaningfully pass some tariff-related costs to consumers. And you really have to go digging for those details to find it, which is, again, another point that says it's not really happening in the way it was supposed to. The Consumer Price Index, excluding the often volatile food and energy categories, therefore the core, increased by 0.2% from May, according to the Bureau of Labor Statistics data out Tuesday. While the decline in car prices helped keep a lid on the figure, that's another one. Why did the decline in car prices happen? Goods categories exposed to President Donald Trump's levies, including toys and appliances, rose at the fastest paces in years. The report gives a little bit of everything to Federal Reserve policymakers who are divided as to whether tariffs will cause a one-time price shock or something more persistent. There's evidence of tariff pass-through for officials inclined to keep interest rates elevated, and yet few signs of a broader reverberation for those who are ready to lower them. And really, the balance isn't nearly as close as it should be. If tariffs were inflationary, if businesses were in position to pass along costs, they would be doing so, and we would see it 5 months into the tariff regime. The fact that we are not seeing it is the real story here. In another Bloomberg article, you actually get people asking these questions. Here's an example. You may be seeing some tariff passing through, but it didn't go up as much as feared, which gives you some relief, according to John Briggs, who's the head of U.S. rate strategy at Natixis North America. But you need to wait and see if you get the tariff pass-through in the coming months. And that's the dichotomy. The tariff fear, the inflation fear is entirely theoretical. There's no evidence for it here. There's just a minor couple of issues in the consumer price bucket where we do see some prices that are rising, but you've always seen prices rising. We've seen price spikes numerous times along the way, and they don't lead to inflation because any prices that do filter through and go higher lead to more demand destruction, which this next quote actually gets at. June marks the 5th month since tariffs were imposed on our 3 biggest trade partners without tariff-related inflation fireworks, said Chris Lowe, who's the chief economist of FHN. The "we need more evidence" crowd at the Fed is likely to dig in and carry the day again at the meeting at the end of this month, but at this rate, the result could be pressure for a bigger cut in September, just like last year. It's one of those things with economists and economics, and therefore central bankers, that's basically unfalsifiable. They believe that tariffs are raising costs, which they are, therefore somehow, some way that has to be inflationary, in a way that when oil prices have gone up a couple times, big time, over the last couple years, it didn't lead to inflation. Somehow tariffs are supposed to be inflationary in a way that oil price spikes weren't. In fact, we saw oil prices spike back in 2023 and again last year in 2024. It didn't lead to an inflationary outbreak, a couple months of an impact on the CPI, but then worsening economic conditions, which is what we're really getting at here with the lack of tariff inflation 5 months into it. The one reason that people have come up with to explain the lack of visible tariff impact on the CPI is lower cost inventory. Companies had piled up a ton of goods earlier in this year, front-loading activity before their costs went up due to duties. Therefore, quite reasonably, they've been able to sell their lower cost items at lower end user prices, keeping the overall impact of tariffs muted. But once that inventory runs out, then it'll be the higher cost goods which will force businesses to either raise prices or get compressed at the margins. But if we're expecting them to raise prices, that assumes that companies have purchasing power to do it, when all the evidence says right now that they don't. If they thought they could get away with higher prices because of tariffs, businesses would have raised their prices right away back in February or March. If they believed for 1 second that consumers were in any shape to pay higher prices for anything anywhere, they would have used the tariff excuse to sell even their lower cost inventory at higher prices. That lower cost inventory was nothing more than like an insurance policy for the situation that we're in now, hoping that they could sell the lower cost items and maintain some level of profitability over the next couple of months, hoping that everything would clear itself up and therefore consumers would be in position to get higher prices down the road. But we see no evidence for that happening. The fact that they haven't done that yet is more evidence for the lack of pricing power among businesses. And that when the low cost inventory finally does run out, that's not when inflation shows up. That's when the reckoning on the weak economy does. Back to Bloomberg one more time. Part of the reason why some companies see price hikes as a last resort is that they fear consumers who have grown more pessimistic on the economy this year will only tolerate so much and eventually spend less, which economists will be looking for in a report Thursday on retail sales. And that's it in a nutshell. Businesses know they can't pass these costs on to consumers because consumers, any rise in prices and costs mean they have to spend less. Volumes disappear. They start cutting back even more. They can't afford it, and they know it. We've got more evidence that the consumer economy is under pressure, and substantially under pressure, with a key cyclical data point in terms of consumer credit. I've talked about the monthly report from the Federal Reserve on consumer credit, especially revolving credit card usage, which is a key cyclical indicator because consumers, when they perceive jobs and incomes as relatively stable and positive moving forward, they tend to use more credit card debt. When they perceive of jobs and incomes as under threat, they don't use their credit cards as much. They don't ask for higher balances. And instead, many consumers will pay down the revolving balances. Now, the monthly data that came out already was from the Federal Reserve, and it was only through May. But if you go into the banking statistics, the H8 data, we have credits from the other side, from the perspective of the banking sector, therefore lenders, and how much consumer credit that banks are holding up until the first week in July. What it shows is that there was a slowdown, the first slowdown in revolving consumer credit all the way back in March and April of 2023, the aftermath of the banking crisis. It wasn't rate hikes that shifted conditions, the bank crisis did, or the perceptions of risk. It indicates that there was a supply side change in consumer revolving credit as banks became more cautious in the aftermath of that crisis, and it was more the supply side than it was any change in consumer behavior back in 2023. But the second slowdown in revolving consumer credit, which did show up in the monthly data from the Federal Reserve, that was March and April of last year, the global inflection that we see all over the global economy. That was consumers who were starting to react to slowing jobs, slowing incomes, raising fears that both jobs and incomes were going to be threatened, and therefore using credit cards less alongside banks who were more cautious about extending revolving credit. And now we see a third slowdown, or really a decline here, a third inflection, starting with May of 2025. This is the aftermath of April's financial chaos and deflation and everything else, but it's really about the awful jobs and income conditions that we've seen in the aftermath of what happened in April. I've talked about the average weekly earnings estimate from the establishment survey and how highly unusual the weakness there was. The actual decline on a 3-month basis is something that's only happened a handful of times. That would be consistent with consumers cutting back on credit card usage to the point that they're actually on net paying down revolving balances, a highly cyclical indication. And in an environment where that's taking place, that would be one where businesses have an increasingly difficult time passing any costs along to their consumers. So they're absorbing higher input costs from tariffs and other factors as well, but they can't get them up to the consumer level because consumers are already cutting back. The consumer economy has indeed shifted in a meaningful way this year, which means tariffs can't be inflationary. And that's backed up even further by the household survey, where we saw just a plunge in employment in May and June, as well as a huge decline, an even bigger decline, 750,000 in the labor force itself. People dropping out of the labor force because there are no jobs. In that situation, consumers are not going to be in a mood to use their credit cards outside of the few who have to as a last resort. But overall, consumers are going to be cutting back in credit. They're going to be cutting back in spending. Therefore, businesses have zero pricing power to pass along all of these costs. And so now we're 5 months into the tariff regime, and we're still waiting for the big inflation jump. And as I mentioned in yesterday's video, banks aren't exactly afraid of inflation either. Despite Jamie Dimon out there hollering about the inflationary impact of tariffs and maybe the Fed raising rates, banks all over the sector, as I pointed out, are buying treasuries by the boatload. The last thing they seem to be afraid of is a huge outburst of inflation. And again, there is zero evidence that's going to be the case. Up until this point, this tariff inflation fear is entirely theoretical, whereas the decline in the overall economy, especially the labor market, that goes along with the lack of pricing power among businesses that we see in the CPI, that isn't theoretical. That is happening right now, today. So after 5 months, we're left asking, where are these cost pressures? Now, we know where they are. They're being left for businesses to absorb, but they can't absorb it. This is proof positive, the 5th CPI in a row, now through June, that they have zero pricing power. If there was any way for them to have raised prices by now, they would have done it. They would have used the tariffs as excuses, and they would have raised costs. And we've seen it in the CPI right from the get-go. What's keeping a lid on the CPI is not just the usual macroeconomic weakness that we've sadly become accustomed to. There's a large and growing body of evidence establishing that the consumer economy has indeed hit a wall. And this leaves companies and indeed the whole economy stuck between that wall and a hard place with few good options moving forward. And I think I heard that somewhere before in certain markets and among several curves. Will the June CPI be enough for people like Jamie Dimon and his massive inflationary warning? What is that inflationary warning even really about? Well, we went over that in the video link below. As always, thank you very much for joining me. Huge thank you, Eurodollar University members and subscribers. And until next time, take care.